It's partly about rates. I mean, obviously, we talked about this before, that there was 4 years in a row, basically, that the 30-year Treasury bond was bumping up against resistance at about 3.25. And I think when we were last together, we were talking about this before, and it held up at 3.25 or so several times, including earlier this year. But then I always felt that if it broke above that, we would start looking at yield curve steepening, and we'd see an acceleration of higher rates. So I think it's pretty clear that part of the issue here is the rise in rates and also the speed with which it went up, which isn't all that surprising. I mean, once we got above 325, we tacked on another 20 basis points really quickly. But there's an issue that's been developing for several months now that I think doesn't get enough attention, which is also part of the issue, and that is the fact that the U.S. stock market, since January 26th, has acted uniquely strong compared to the global stock market, including everything except the United States. It's a really fascinating chart. I had it in my webcast a month ago, and I was pointing out that that was a really strange divergence and one investors needed to pay attention to. Basically what happened, Judge, is the U.S. stock market, and compared to the entire global stock market, excluding the U.S., went up in tandem about the same amount and with the same pattern from the year-ago period into January 26th of this year. And if you normalize the lines so that they both meet at January 26th, it's really interesting because they fell together. The U.S. and the world stock market ex-U.S. fell together into that February mini crash, and they fell the same amount. And then they rallied back up together about the same amount. And then they fell back down together about the same amount. But starting in about June, something really strange started to happen because for the months before, they were acting identically. But starting in June, the S&P 500 went on a solo journey to new highs. It actually went up about 12 to 15% above the point that it was at in June when the U.S. stock market and the non-U.S. global markets were basically at the same starting point. However, at that same time that the S&P was going to a new high, the global stock market ex the United States went down. And it went down to the low of the 12-month period, and it went down about the same amount that the S&P 500 went up. So you had this alligator jaws divergence on the chart that was really, really interesting because one market, the U.S. exclusively, went up by about 12 or 15%, and the global stock market ex-U.S. went down. And I said in my webcast, I think that if the global stock market heads lower still, that there's no way the U.S. stock market can hang in there because the divergence is just too big. And if the global stock market is really going to take out the low and put in a new low, something bad must be happening. And I don't think the U.S. can hold in there. Well, what happened as rates broke to the upside on the 30-year, the global stock market ex-U.S. did take a new leg down and did go to a 12-month low. And so it's interesting that the S&P 500 did what I said it would in my webcast, and that is join the global stock market on the way down.